Well, welcome back to Professional Dairy Producers and the Dairy Signal. Boy, hasn't 25 been a year of dynamic swings? I guess that's the best way to say it. As dairy farmers and those of us who are also dealing with crops and fat cattle and all the sorts of things, it seems like anything that comes from the soil this year has seen a lot of dynamic twists and turns in the marketplace. We've been up, we've been down. And now we're kind of in another one of those down cycles in dairy. Today's episode of the Dairy Signal, though, we're going to be working with Will Babler from the Pinion Risk Management Group. And Will is a principal owner there. And what Will is going to be doing is taking us into some things that we should be looking at and watching for 2026. And really, what are some of how we read the tea leaves, even going farther out into our business. So all the underpinning with professional dairy producers is education. We know that business is going to have its times of challenge, and it's usually in those times of challenge that we find the answers that build our resilience and our strength. And certainly today's episode is going to focus on all of those things. So sit back, strap yourself down, and get ready to learn some things that are going to help us move into 26 and 27 with a lot of optimism. Also, though, no, there's two things. One, you can get continuing education credits for today's episode, as well as we want you guys to participate. Ask questions. If you're live streaming with us, type your questions in. We'll present those to Will towards the end of the episode. So here we go. Turning it over to my friend, Will Babler.
Thanks so much, Shelley. Appreciate the opportunity today. And as Shelley said, it's been an interesting year thus far. And we're going to take a look today at a lot of the questions that come in as we're working with clients in the dairy industry all across the country here in the Midwest, where our offices are, as well as the West Coast, East Coast, and everywhere in between. Big focus that I'm going to touch on here is just the shifting margins in dairy. And it's been a little bit unusual. So what's been driving that? Some very unexpected things that have pushed prices and margins around this year. And then we'll try to get to the end and looked at just some very practical hedging opportunities, especially as Shelley said, coming through a tough patch here. What is visible to us now? What can we do from a practical standpoint out into 2026? So that's going to be the focus of today's discussion. Looking forward to your questions as we wrap it up at the end. Just a real quick intro here about our firm, Pinion Risk Management. We're a commodity trading risk management firm. We work in advisory, brokerage, and crop insurance with clients all across the country. We got about 30 folks in our team that are doing that. Been at it for 25 plus years. The vast majority of us deep roots in ag, on the farm, growing up in these markets and in these industries are still tied to it yet today. And then we kind of tie back in through Pinion, which is a leading food and ag consultancy and accounting firm where we help provide some of the advisory services on risk in that overall ecosystem. Real quick about myself. Grew up in Southwest Wisconsin on this dairy farm here, so been around this industry and for as long as I can remember, and really enjoy speaking and talking with our clients and staying involved. Something I've got a background in with grain, beef, and dairy here on the farm in Southwest Wisconsin. When we think about what we do on a day-to-day basis, and it ties back into here as far as our services are concerned. Really margin management, pulling together all these moving parts in the markets with insurance tools, with cash contracts, with futures and options, and also recently with a dairy farm business management team brought in to help have good numbers to base our risk management decisions on. So that's a little bit of a background about myself and our firm and how we're looking at serving clients in the dairy business. Specifically today, we're going to hit on these main bullet points. Again, kind of the main idea is where these margins have been shifting. They have been volatile. Some of it's been unexpected. Some of it has been maybe once in a decade type moves. And then what those really lean into, whether it's in milk, feed, cattle, kind of looking at some specifics with each of those. And then wrap it up with what can you think about? What can you do right now to take advantage, either play offense or to play defense in certain circumstances? So with that in mind, we're going to take a first pass here at what have dairy margins been up to. And, I kind of have the text here on a few things that are pushing it. Certainly cow numbers, components is a big issue, and then where does that manifest itself in terms of price trends? So one way that we've thought about looking at this is kind of the evolution and that shifting concept was what has changed here um, in this most recent season, if you will. So this is kind of a look back at what have margins for the first quarter, that'd be starting in January, what have those margins looked like as we've moved throughout the last, say, since June, the last 6 months? And on this chart, the margins are reflected here in the orange line. And we spent from June into September, not the best, not the worst, just north of break even in many cases, kind of for representative dairy. And then you can say, okay, well, that started to fade pretty fast come fall. Summer wound down, the orange line started to drop, margins fell off pretty dramatically around $4 a hundred in class three and cheese heavy markets. And that was despite a rising cattle market. So the cattle market was pushing higher, that was helping margins out. But a lot of that drop was through the blue line here, class three, or more specifically, back in through your net milk check price, you see that dropping even harder. And that is kind of a function of PBD values dropping as class four has been under pressure, component values dropping as the butterfat market's been under pressure, even more so than cheese. And those things were conspiring to pull the margin down, even as the cattle was helping out. And feed was effectively neutral, if not slightly positive to it as we moved into the fall. Then in October, we started to see that cattle market drop. It's still a positive contributor, but is losing ground, to the tune of a buck, buck 50, maybe even $2 at certain points of giving back some margin. So there have been a lot of moving parts. Feed hasn't done much to it. Cattle's a big help early, faded late, and then the milk side's been driving a lot of the challenge, that Shelley alluded to. It's been a tough back part of the year here, and it's mostly come from that milk side. If we think about maybe depending, I know we've got a pretty wide audience, but if we expand out of our backyard here in cheese country, or even say in the Dakotas or Texas, wherever it may be a heavy cheese market, you move to the coast, it's been even tougher. So that drop you can see maybe in the prior slide was in the $4 to $5 range on margin, called the $4 range of margin. Here we got margins dropped to nearly $6 in that 6 month window. So the class four market's been under more pressure, largely because of what's been going on in soft international markets and kind of a tsunami of butterfat and a really quickly degrading butter price. So these have been the things that have been pushing the market, pushing margins in recent months. And when we think about how that stacks up, kind of that roller coaster that, Shelley did a nice job of introing this. We've had some good margins through 24 and 25, as indicated by this blue line. This would be a gross margin, kind of playing off the DMC program as your formula, but adding in beef on dairy, which is really something we need to do now because we've got maybe more than one foot in the beef business now for dairy producers these days. And you can see it's been a very positive margin environment, but it's been fading fast through 25. The dotted lines would be the projected prices of futures hold. And you can see that we've come off quite a bit. We're more towards the average if you include the beef in. It's not such a terrible margin throughout this period, but you see it's had a ton of volatility and it's been dropping sharply. So that's what's been catching people's attention. And we think about what that big driver has been in the margin and in those changes, it was really highlighted that was on the milk side. So we are seeing an incredible production expansion here. The October number is kind of off the charts in terms of growth. You can see that we finished up, prior year very strong as well. And what's going on with this is, somewhere around 4% nominal growth, maybe 6% on a component adjusted basis. There's a lot of milk, and it's come, as I said before, in a bit an unexpected way coming into this last 12-month period. We're sitting at incredibly low replacement numbers, and yet we still added north of 200,000 head. So this herd expansion has been incredibly steep. You can see it's even steeper than some of the others just in terms of slope, and the magnitude of it is pretty enormous. I mean, we've seen maybe a bigger one over multiple years. We had maybe 300,000 head, but we've done 200,000 a year, which incredible growth. We're finding that those replacement numbers didn't tell the whole story. Some of this is through a lot of retention and holding cows for extra lactations here, but it's also through maybe some phantom numbers in terms of what Uncle Sam's reporting and what was actually coming through that heifer pipeline. So too many cows, too much milk, not a friendly price environment. You can see this growth is pretty widespread, which is new. A lot of times we would see this in certain isolated pockets. Right now, we're kind of catching it most everywhere. There's a few states that are really having a tough go, but Texas, Kansas, South Dakota, booming, even your kind of core upper Midwest, cheese states really going strong, Wisconsin, Minnesota, Michigan. And then kind of a sleeper there is this huge expansion in New York that's kind of piggybacking off of a number of policy changes there, tax credits, renewed interest in processing, expansion from existing players, consolidation. And that's, a big deal as well, which has maybe been under the radar until these numbers have really started to pop there. So widespread expansion going on. And then to add insult to injury as far as prices are concerned, all that milk is coming out with incredible levels of butter fat. We've seen crazy growth in those butter fat levels in recent years. Big changes on genetics, especially, but also just rations and production systems and everything else helping push that. So it's been a lot of milk supply growth, and we're not alone. When you think about the big five exporters, they're all in growth mode as well, except for Australia here in terms of year-over-year basis. The EU is kind of the monster there. It's pretty tough for them to push these 3+% increases when you think about how huge they are, but that's what they're doing. And we've got, some really heavy synchronous growth on world milk production. And that's been hurting prices, not just here, but overseas. I just pasted this in last minute. GDT was out, down 4% again today. That world market is under pressure. And you kind of add all that up, and I kind of highlighted this. At first, I was just going to show the butter price collapse because it's kind of been the most extreme. You go back a little over a year, and we're north of $3 in butter, and talking with people in the consumer side of the equation who are buying butter were terrified it was going to four. Well, you fast forward a little bit, now it's been cut in half. So it's been a drastic move lower on butter. Kind of that dual punch of more cows, more milk, and crazy high components across all the herds. Um, Cheese has not been faring well here lately. That spends a lot of time in this 160 to 190 range, and we just kind of broke through that in the last couple of weeks as well. So that's kind of down into another sort of spot price that's been tough on the cheese side of the equation. So if we think about what this has done and why some of those markets and margins have deteriorated so much, it's been a steep drop. You go back and we're in the 20s on class threes and fours, down into 13s is a pretty deep discount on class four milk at the moment, class three in the 15s. It's been a tough drop. When you think about that from a longer perspective, let's zoom this out here on the monthly, go clear back to some of the tougher times and say 2009, 2012, 2020. We're kind of down there on class four in the bottom of that range. It certainly can get worse, and it has. We're hoping that's not the case. But we're in a pretty tough spot when it comes to the class four side of the equation. And we're kind of on the wrong side of the midpoint on the class three market here as well. When we think about this kind of expansion, again, a bit of an unexpected expansion given the replacement numbers. We've seen these types of drops before where we get, 30, 50, 40% type drops. We're kind of in that zone now in the 30 to 40% range. So we're not surprising given the expansion we've seen, especially if you think about, 4% milk production growth. So we're kind of in a tough spot, and we've got a lot of open questions about, well, where is this going to take us into next year? So we kind of think about zooming out, we're in a tough level, but if we put in perspective again and we say, okay, let's look forward where we're at. This is looking at the back half. The red price is the back half of next year. We're still north of 17 there, even though we're in the 15s on the nearby months. So that indicates that there's still some opportunity out there. And what we'll get to when we kind of move through these other markets is, well, what can we do about that today? So I think it's an important one. Sometimes when these markets are under pressure and you're feeling the strain of these really low nearby milk checks, you can lose visibility to what's out in front of us. But we do have some things that aren't too bad if you think about what's out into the back half of next year. Um, and speaking of things that aren't too bad, we still have this beef on dairy market, which has given us a lot of opportunity. I think we looked at this when we kind of did a beef on dairy LRP intro a few months back with you guys, and this has improved even a little bit since then. But the main point of this slide is that we spent a lot of time with beef value on dairy contributing about $1.100 of revenue, and that's basically 5x in the last 3, 4 years. And that's still holding up even with a bit of a drop in the cattle market. We've seen these $1,500, $1,600 a head cross calf prices have faded. Fortunately, they're still north of $1,000. The relative price versus feeders is held up pretty strong. So again, you zoom out, this is a lot better than where we've been. It's been a sharp drop, but this still represents a huge amount of revenue opportunity for producers who are in the cross-calf game. It's been kind of a wild ride since October. We watched on the very first slides here as the margins improved with beef value, and then we gave some of it back. This was the giving it back on fat cattle and feeder cattle. I probably should have took out my highlighter and noted the number of limit moves in here. There have been a lot of limit moves, a lot of expanded limit moves, both up and down in the last month and a half. Incredible volatility in this market. But again, if we zoom out, we're still miles above the old highs and still in actually a pretty decent price level. It can be a lot tougher for maybe other segments of the cattle market, but I think actually for dairy producers, we're still in a spot that's given a lot of opportunity. And where that opportunity ends up, this list probably can be longer, but there are so many things that are in question here on this cattle market. The underlying supply and demand dynamics are pretty supportive, but you can kind of run through each one of these items and see potentially huge shifts. I mean, just even on Argentina, change that tariff rate quota there, kind of pricked the bubble and the market started to tumble. Brazil tariff removals were being rumored, and then it became the case. Mexican border is still closed. If that opens up, there's going to be a ton more volatility here. Most recently, Tyson closing plants in Nebraska and slowing them in Texas. That's taken away demand on the cattle side of the equation. Consumer is a great mystery to me as to where they're at and where they're going. Thus far, they're still buying an awful lot of beef and holding up better than I expect. Substitution impacts, those are still going on. Expect the poultry and pork side of the equation to take share. And then we do see a lot of projections for expansion in this cattle business as far as retaining heifers and growing that herd again. And then there's always kind of the cattle cycle. We're pretty used to a 3-year cycle or something like that in dairy, where you get a lot of swings in a shorter time frame. Cattle, there's a lot of pundits that are seeing that, well, we may have crossed the Rubicon here. We're moving to the back end of the 10-year cycle. And if that's the case, you can expect a lot more volatility in that market. So that's kind of where we're sitting in cattle. And I think what we'll look at as we jump ahead to managing margins is pulling in some of those other tools, which we'll touch on in a second around LRP. Last one I'll touch on is kind of a sleepy one on the charts. There's almost no impact, if you remember, on feed. So the question is, well, what's going on there? Pretty tired market on corn. We've got kind of a level of ambivalence from producers and end users that I'm talking to on a day-to-day basis of not a lot of concern, not a lot of excitement. If you look into the soybean side of the equation, then you find a little bit of excitement. I think the main thing we've seen is almost a zero heartbeat on soybean exports until the recent deal with China, and now it's started to pick up. So this chart, you can see we've come off zero on export sales pace, but we got a long way to go to get back to normal. But just that change in policy really popped this protein price. So when we think about a lot of producers, a lot of silage is homegrown, may or may not be in a destination market covering corn. Most everybody's got to bring in some of this protein, whether it's through bean meal, canola, et cetera. And that market has really moved substantially, 260 up to 330, huge rally on that policy change. I think the big thing on this one is that if we zoom out, kind of like those other markets, we spent a lot of the summer down at a 9-year low in this market. We're still at an okay price. That for sure was a good price. And when we think about that, one thing that I just wanted to maybe share today on this side of the equation is that there's so many different tools and approaches and processes for managing risk. Um, we do our best to help make them understandable and simplify them down. But this one is almost as simple as it gets. And I just want to throw it out there. There's almost a little bit of a case study on where were we on the feed side of things. A 9-year low, zooming out on that monthly chart, should start ringing some bells about, hey, this looks like an opportunity. Again, going to that concept of how we play offense on risk management. Furthermore, the cash markets were really weak. It's been a huge expansion in soybean crush capacity. Those crushers were looking to find a home for anything that they could, and deep discounts on basis. So cash versus futures down -40 range. Again, all the alarm bells are going off. What does that lead us to do? What did most of our clients on the feed side of the equation, end user side do? Bought cash, fixed price cash contracts, about as run of mill as it gets, but it does require a decision to be made. And it is a decisive position to take because you're stuck at that fixed price. But in this case, it was kind of the perfect example that sometimes the simplest tool and the simplest rule is the best way to take it. If we're at a 9-year low on flat price, if we're at multi-year low on basis, sometimes you just buckle up and buy it and move on, especially if you can cover the margin on the back end on milk and cattle. And that was largely what folks have been doing. If we see that line up again, that playbook comes back out, but I just kind of highlight that, as where we went throughout the summer in that market, especially on the feed side. That one does lean a little bit into the practical hedging side of things. I think, that was a moderate piece of the puzzle. But as we think about what are the bigger pieces that we talked about today, milk and cattle are the two that jump out. How do we play offense on cattle? How do we play defense on milk? And what are some ways to think about that? And I think the first thing that we always advise is to roll all that together. When we think about any one market, there can be signals like we saw at an extreme in protein or maybe an extreme in cattle, but we don't want to get overly fixated on any one market or any one narrative because, we can't call the tops, we can't call the bottoms, but we can look back and say, well, what has the margin been like we did at the beginning on those DMC margins? And we say, well, if we get all of our information together and we dial it in for your operation, we say, let's get your costs, your components, your production, your feed efficiency, your fixed variable costs, all those things, and put them into some kind of system, however you do it. This is how we do it for our clients, but it gives us a way to market the market every day. That gives us the visibility to know where am I at? And I think when we look at where am I at, what do my numbers tell me? This was a visual that I think is useful for thinking about the tough times in the fourth quarter and thinking about just generally how these risk management tools work. So the idea that I kind of want to convey here is that, over time, we're seeing the margin evolve. So if we think back about those earlier charts, the margin was going up and then it started to fade pretty aggressively here. So the market margin, the blue line, went from about 4 down to -1, which is the change we saw was about a $5 swing. That's your same $5 swing and why it happened. From a hedge perspective, the red line, Well, when you hedge, you give up something, right? We're going to give up some upside by spending premiums. So the red line was lagging all along, whatever it was, 30, 40 cents a hundred. Pick a number depending on your budget, your appetite. But as the market faded, that red line got arrested to the downside. It did not continue to fade, and the gap opened up, right? So the hedging tool did the work. Now, to try to jump in Q4 and get this coverage on, it's too little too late. These are examples of positions that are taken way out, a year out, maybe even 15 months out, in order to get this profile, in order to remain cash flow positive. This is net of everything, net of P&I, the whole works. That margin approach can empower you to get those positions in play. So when we think about, as Shelley was alluding to, well, what about next year? Where are we at? Nobody likes this Q4 in the red, right? Negative a dollar, not a lot of fun. If you hedged it, you're still a positive margin, or could be depending on what approach you took. But what about into next year? And this is kind of a representative Midwest producer. Look, we've had good crop yields, feed's plentiful, feed costs are reasonable. Um, Production is strong, right? So basis, your milk check price versus class three is really strong here. And cross calves, Kim here in our office calls them, black gold, right? And I think that's right. It's very valuable piece of revenue that's coming in. And we look out in front of us, there's still actually margin to be had. So the big thing that we want to talk about is that there's a trap that a lot of folks can get into, is that the recency of a tough situation blinds them to the opportunity that's out in front. And we still have some opportunity out in front. So the question is, well, what are we going to do to get after it? We've talked numerous times on the milk side about DRP. The big thing with DRP is that this provides a price floor and leaves the upside open. Uncle Sam's showing up to pay roughly half the bill on premium, and it creates a good opportunity where not only can you control your downside and have all the upside left, if you're a consistent user, you can help capture that subsidy back out. And I think right now, when we think about what's in front of us with DRP, is we want to avoid the other trap of saying, oof, I don't like $15 nearby prices, 17.27 for Q3, 17 and a quarter for Q4. That looks pretty good. Let's run out and fix that. Okay, well, that is an option, and you might be interested in doing that on a portion of your risk. But as we look back at some of those other troughs, we could go to 2009 levels, we could go to 2020 levels. But as time burns on, we may also see a rebound. And that's where the flexibility on DRP in our mind comes out ahead, is that if you're constantly leaning into that, scaling into those positions, you can get that benefit of the downside being protected and maintain the upside. And if the cycle turns, you can catch the turn higher. If it goes lower, you've mitigated that risk of the downside. And how much of it and where that break even is really depends on your operation. We can call these roughly a $16 all in. So you figure about $1.25 below the market. And depending on where your margin structure sits, that could be a pretty good positive margin for Q3. And it could be, you might be sneaking by the skin of your teeth in Q4, but you know where you're at on positive cash flow. Now, this is going to vary for everybody. But the point being is, if you've got the tools and you're diligent about understanding where your numbers sit, you can make those choices where you say, hey, I know where I'm at. It's maybe a positive and maybe a little above break even, but yet I've got all the upside open. And that's a good place to be in, especially if, right now you're looking and you're watching the cash flow going negative, right? So that's what we're trying to avoid. And this opportunity is in front of us. Again, mostly playing defense here. Now, on the other side, we think about cattle. We're still not far from record highs. LRP is a new tool. You can look back and go through the presentation we did a few months ago to get into the weeds on all the details. But the premise is similar: 35 to 55% subsidy on the premium, covers a minimum, leaves all the upside open. Just came out this year. There's many different ways to cover these calves and to cover the cattle market. When we think about the cash contracts, simple is best, but they're often not available for this particular commodity. LRP it's cheap, it's effective. We've been putting on aggressively for clients. Uh, and there's still plenty of room to get coverage clear out to the end of next September. And we think about what that looks like, you know, this tool is projecting out at 1229 a head average price for that strip. Still very high price, maybe not 1500 like we liked. 1229 is still pretty good. We can come in here with an 1137 minimum for 30 bucks a head. So $1,100 floor on cross calves in a piece of the margin and revenue puzzle that's 5x in recent years, to me is an incredible opportunity to go play offense and protect this value. So you start to piece all these together and you can find a way to avoid what we're seeing today if you're unhedged and having a tough go to finish up the year. This is a way to set yourself up for success out into 2026. There's some ingredients there of understanding the tools, getting your arms around your numbers, and probably more important than anything, just not getting too fixated on the present that causes inaction in the future. So with that, I kind of wrap it up. Pretty much everything we're doing in risk management is to take away the risk on the things you can't control. I can't control the market. I can't control policy. You can't control policy, but we can use the tools to protect the price. And when we do that, it lets you spend your time and efforts on managing the operation, investing in what's going to make you more productive, more efficient, and not get derailed by the swings in the market. I think that's always a big takeaway. We're trying to help utilize these tools so that you have a bridge through the ups and downs to continue to reinvest and to focus on improving your operation. We know these markets are going to stay volatile. I don't know if there's anything that introduces more volatility than a pen these days, the way the policy keeps changing. I would expect that to continue. We can go on offense on LRP. We can go on defense with DRP right now. If we know our break evens, we know our exposure, we keep the upside open. It gives us a great opportunity to get out there and capture that. And then I will highlight too that we're always looking for the best available tools. Sometimes it's going to be like that protein market, lean heavy into the cash side. Sometimes it's going to be these subsidized tools. Don't take for granted what the value of that subsidy's been since they've been introduced. And then the last one that I always finish with is these are all nice ideas, but if you don't have a good plan, if you don't stick with it, it's going to be really hard to see those results. Show that example of with the Q4, with the market collapsing and the hedged margin holding up. That's not any kind of result of having a good crystal ball like it's on the screen. That doesn't exist. That came through consistency of people who had a plan and stuck with it. And I think that's where all ended up. So appreciate your time. And Shelley, looking forward to any questions that you might have or the crowd might have.
Absolutely. So as you guys come up with some questions, I guess I have a couple review points, if you want to say, Will,
Sure.
that I think that might be helpful for folks. So we're in the trough now. What I'm hearing is beyond attitude. It's really hard on these dairies for us when we're in the trough to keep our heads up, but the cow and our business and our partners demand that we bring our A game every single day. So it's attitude. And then on top of that, the aptitude of looking forward and grabbing some of these resources. So you talked about volatility
Hmm.
and having dairied for 40 years. Sometimes the word volatility, when it feels like everything's kind of in the drain, is good news. Things are
Hmm.
bouncing around. So watching these markets and looking for the opportunity. One of the things I saw was just protein. There's some
Hmm.
opportunity there well, the market's down if you're looking at controlling some of your costs going forward. Could you reiterate that? Maybe take us back, because that looked like,
Yeah.
one of those points that folks really need to grab onto. And not just that is the point, but that is an example of
Hmm.
how when things are in the trough and there's volatility going on out there, there's also opportunity. So buy low. We'd like to be selling high right now. We don't quite have those levers, but at least we can lock in some of our future feed costs.
Yeah, and I think that's exactly it. We always say that volatility cuts both ways. If you don't have much volatility, you can end up in a market that just kind of drags down into no man's land. And I think in this case, this opened up for those who are prepared to take action, and having some kind of rules or triggers or timing in terms of, hey, I'm going to regularly look at this market. It doesn't mean I need to do anything, but if I'm looking at it every month and I'm understanding my exposure, and you're going to see the alarm bell go off, you say, well, okay, we are at a 9-year low. Let's think more about that. But why is that, right? Well, there's no export demand. Why is protein so weak? There's an enormous expansion in crush capacity. What's that done to basis? Oh, lo and behold, basis is falling apart. Having some of those triggers or hacks to avoid ignoring it or to avoid getting too greedy can really help you grab those opportunities. So again, sometimes it's just keep it simple, periodic check-in on what's going on, curiosity to see why it's happening. Maybe it opens up something that tells you a little bit more about the basis side of it, and then being decisive and doing something about it. That can help you grab the good side of this volatility too. So I think that's a good one to point out.
So give me, as we're in December, so things are getting pretty buttoned up on the farms. We're finishing off
Mhm.
getting equipment put away. In Wisconsin, or at least where I'm at, we got a good, 10 inches of snow on the ground right now. So that kind of cuts out some of our other our options that we might have been working on as we had a beautiful fall. What are 3 to 4 priorities that I should have right now? If I don't have a plan, if I don't have a partner to execute that plan, there's some options there. But what are some other things I need to be thinking about as I'm rounding out 25
Mhm.
with the audacity that 26, by golly, I'm going to get a jump on things. What should I do?
Yeah, that's a really good question. I think there's a lot of things to do, but if I would say that two really jump to mind, one one would be sort of the task of getting your arms around your numbers, so to speak. And then the other one would be really to make sure you've educated yourself. And this is maybe switching the order normally what I would say on LRP and then DRP. DRP has been around for a while, so most folks probably know about that. But the LRP really needs to be scrutinized. So if we start with the first one, get your arms around your numbers. I think that having a good understanding of how you wrapped up the year, pushing towards accrual style financials where you've got, whether you're doing it yourself, you're working with a farm business, farm management partner who's helping you dial in those accrual-based financials, and then using that to project out what your budget's going to look like for the next year. You know, there's work in that, and that also comes through consistency of doing a good job with those things. But getting your arms around that is important. Um, we've seen that even more and more as we've kind of brought that team into our group where they're able to help people kind of jump up the learning curve on that and actually execute on it. So understand where your numbers are at and then spend the time to educate yourself on specifically the LRP side. Because once you get your numbers clean, you're going to see, if you haven't already, everybody knows the sticker shock on what a cross calf has been worth, right? But when you see that flow into the financials and you think about, oh my goodness, maybe I'm only making $1.00 net. Well, five of that came from the growth in cross calves and culls combined. If that goes away, there's going to be a big hole in the income statement and hopefully not in the balance sheet. So taking the time to get your arms around those numbers and then educate yourself on those tools, especially on the cross calves, I think those would be two things that are worth anybody's time. And there's always room for improvement for sure on the first piece. And maybe you're an expert on the second. Well, then I might say, okay, if you're an expert on the cross calves, let's talk about the cull cows. And that's an entire another can of worms, but it's something that should be looked at as well through other traditional, hedging tools. So those would be the spots where I'd probably start. And they're probably good spots whether you're deep in this or not. There's some room to improve on those, in both areas.
Okay. Well, right now, I'd say there's the opportunity of the volatility. And then as we come into the end of the year, coaching that we've always seemed to receive from our financial experts as well as our business experts is keep communicating. Make sure that all your partners in your businesses, you're just really open and honest with one another because sometimes there's something so glaringly obvious, but you can't see it because you get very emotional in these times when you can't make the ends meet. That's you can fixate on that and you can miss the things that really could be the driver in turning and solving the solution. So making sure that you're tapping all your resources and keeping your partners in the know as well. And then lastly, net worth has no strings attached to self-worth. And that kind of goes to a lot of being able to bring your A game. We're getting together for the holidays with family. We're celebrating with employees, and everybody's attitude and how everybody feels is really it's important this time of year that we're watching and taking care of one another. So yes, the business, we got to run it like a business. But in the end, it is the net worth, it's not self-worth. And you can bring a lot into someone's life just by asking them how they're doing, and looking and keeping your eyes open for opportunities. So the fact is on the business side that your team and there's other resources out there make great partners. It's a great time to look at things when um, prices are low and being able to grab up some of those opportunities. I want to thank another partner that we have here. The Dairy Signal is something that's been consistent and has been running. This is going to be going into its sixth year very shortly as a resource out there for dairy farmers. This particular episode with our partners here with Pinion was brought to you by Zimpro. Now, Zimpro is a minerals company, a research, they're grounded in research and helping us take care of our cows and making sure that we're thinking long term about health and making good decisions. But Zimpro is an example of a long term partner and partners that have seen the dairy industry evolve and change, but they've been partners that have stood by dairy farmers in the long haul. And that's a good example. Professional dairy producers not only appreciates Zimpro for bringing you the dairy signal, but appreciates all of our national partners. I want you to go out and look at the people that we're doing business with. They're the people that you can count on every single day. And with that, we count our blessings. And I want to say thank you to Will Babler, principal of the Pinion Management Group, for being with us today. And his contact information is up here on this last slide. If you end up picking up the recording, feel free to give hold of Will. You can reach him at 800-884-8290. And with that, we're signing out from Professional Dairy Producers. We hope that you make this day your very, very best and you keep looking forward into the goodness that's going to come in 2026 and beyond. Thank you very much. Have a super, super time.